On the 29th of July this year, Microsoft closed out its financial year and beat Wall Street on every line late matters. The latest day, the stock rose 15.5%, its biggest single day since 2008, adding roughly $480 billion of market value. But there is a twist. Very in late December release. Underneath all the good numbers, Microsoft restated its capital spending for this calendar year to about $175 billion, down from about $190 billion. And that is not a standing cut, it is an accounting reclassification with the useful life of its data centers stretched from 15 years to 25. Capital spending in the quarter was actually a record $41 billion, up 69%. Free cash flow for the quarter came in at $19.6 billion, against $55.4 billion of operating cash flow. So today, how Microsoft actually makes money, how was happened in the last few weeks, and the risk that never make it into the highlight reel. Let's get into it. Quick intro: if you are new here, this is Introcorp by us. Every week, I will take the company apart, the business model, the latest news, and the risk in the about 15 minutes. No hype, no thumbnail with rails. Here's a run of the show. First, the business. Three segments and where the growth margin actually sit second. Azure at 43% growth because that is the engine. Third, Copilot and the AI live 30 million seats and Azure passed $100 billion of annual revenue. Then the news. The $175 billion CapEx plan and the OpenAI reset in April. And finally, the risk, which is honestly the part I watch if you are only here for one session. Numbers to anchor everything else. Fiscal 2026, $331.8 billion of revenue, up 18%. Operating income of $155.2 billion, up 21%. A 46.8% operating margin. For a company this size, that is extraordinary. Now, the number that experienced the whole episode. Free cash flow in the June 2026 quarter was $19.6 billion, not for the year, for the quarter, against operating cash flow of $55.4 billion. The difference is still the Buildout. Over 30 billion paid Microsoft 365 Copilot seats as of the June quarter, up from 20 million in April. Azure pays $100 billion of annual revenue in fiscal 2026, up 41%, and a market capitalization of about $3.45 trillion as of the 31st of July. Was holding on to that last point. The business has kept compounding, and this time the stock has caught up. It rallied 15.5% in a single session on the 13th of July. After results, though it still sits below its 52-week high of about $555. Three repeatable segments and one layer that runs across all of them. Intelligent Cloud, that's Azure, and the server business. $39.3 billion in the June quarter, up 32%. Azure itself grew 43%, accelerating from 40. This is the growth. Productivity and business processes. Microsoft 365, Dynamics, LinkedIn, 37.8 billion, up 14%. Smaller than cloud now, but still the highest margin thing Microsoft owns. It is also the distribution channel. Every Copilot set is sold into an existing Office relationship. More personal computing. Windows, Xbox, Search, 12.9 billion, down 4%. There was an Xbox impairment charge in the quarter. This is a legacy franchise and is still shrinking. And AI, which is not a segment at all. Microsoft disclosed over 30 million paid Copilot seats this quarter, and Azure pays $100 billion for the year because AI is not a segment. It shows up inside O3. That is why capital spending is where it is. So the harness discretion of Microsoft is a very profitable software and the cloud franchise being taxed heavily to build the AI capacity. That is meant to extend it. Cloud is the growth, and now the larger half of the business productivity is still the margin. Let's stay on Azure because this is the whole growth story. 43% growth in the June quarter, that beat guidance, and it beat a roughly 40% consensus, and this is a part people missed. It was an acceleration from 40% in the prior quarter. A business this large is not supposed to speed up. Microsoft's cloud overall reached $59.3 billion in a quarter, up 27%, and a record $214 billion for the full fiscal year. And the headline disclosure, Azure crossed $100 billion of annual revenue for the first time in fiscal 2026, up 41%. Azure is roughly 21% of global cloud infrastructure, and it is growing at something like twice the pace attributed to AWS. Now, the number that cuts both ways. Contracted backlog, remaining performance obligation, is $678 billion, up 84%. That is an extraordinary flow on the future revenue. It is also heavily concentrated. A significant part of it is OpenAI. And looking forward, management guided Azure to roughly 45% growth in the September quarter. Which brings us to the Buildout. This is the slide that matters. Capital spending was a record $41 billion in the June quarter alone, up 69% year-on-year. About 2/3 of it went into short-lived assets, GPUs and CPUs, hardware with a depreciation life measured in a few years, not decades. For the full fiscal year, capital spending came to $145.3 billion. Then the guidance, and this is the nuance to get right. Microsoft restated calendar 2026 capital expenditure to about $175 billion, down from the roughly $190 billion it guided in April. To be precise here, net is not a spending cut, and here is why it truly changed. Microsoft extending the estimated useful life of its data centers and office buildings from 15 years to 25. They ships more of its future data center leases from finance leases, which count as CapEx, to operating leases, which do not. The underlying investment plans are unchanged, and the fiscal 2027 is guided higher again, about $50 billion in the September quarter alone, and around $175 billion for the year. Basically, 31 new data centers across 5 continents came online in the quarter, adding about a gigawatt of capacity, 88 data centers across the 4 years. Management still expects the total capacity to roughly double within 2 years. And here is why it does to the financials. Free cash flow was $19.6 billion, while operating cash flow rose 30% to $55.4 billion. Gross margin slipped to 67% as the data center depreciation lengths and the mix shift toward Azure. Why does this matter so much? Because everything above today's earnings is downstream of this working. Agent's AI platform sure. The next decade of Azure is the single largest capital commitment in corporate history. But know that the market has now flipped. Investors rewarded this quarter precisely because the spending showed up as accelerating Azure revenue and the growing backlog. Let's talk about OpenAI with Microsoft. The relationship nobody can value properly, and arguably the most consequential thing on Microsoft's balance sheet. Microsoft has put roughly $13 billion into OpenAI since 2019. That position is now carried at around $135 billion, close to 27% of the company on a diluted basis. On paper, one of the best venture investments ever made. But on the 27th of April, the turn changed materially. OpenAI's revenue share back to Microsoft is now capped at $38 billion in total through 2030. The AGI clouds the prohibition that had caused so much proliferation. It's gone. Microsoft's license to OpenAI's models runs to 2032, but it is no longer exclusive, and OpenAI can now serve customers on AWS and the Google Cloud. Read that carefully. Microsoft kept first access the primary cloud position. It gave out exclusivity. And the stack now moves reported earnings on its own. Across fiscal 2026 as a whole, The OpenAI stack added about $5 billion to net income and 67 cents to earnings per share. But in the June quarter, Microsoft market rate stacked down by about $600 million, cutting roughly 7 cents from earnings per share. In the same quarter, Microsoft separated $5 billion investment in Anthropic. Made in November 2025 alongside Anthropic committed to buy $30 billion of Azure service, produce a $3.2 billion gain, adding 33 cents to earnings per share. These are mark-to-market lines on private companies sitting inside a public company's result. They cut both ways, and investors are effectively pricing a black box. And know this, Microsoft earned nearly as much from Anthropic in one quarter as it did from OpenAI across the whole year. The hedge is now real. Now the part everyone watched, which was not an early mix. 29th of April, Microsoft beats on everything. Revenue $82.9 billion against $81.4 expected. Earnings per share $4.27 against $4.06. A draw of 40% against about 38 expected. A clean sweep. 13th of April, the stock falls roughly 3.9%, closing near $408. Not because of the quarter, because of the $119 billion capex plan against about $154.6 billion expected. 25th of June, the regulatory picture hardens. The FTC widens its boundary probe and also reaches a premium review that Azure should be designated a gatekeeper under the Digital Market Act. Then, on the 29th of July, Microsoft reported fiscal fourth quarter results. Azure up 43% and past $100 billion for the year, and capex for calendar 2026 restated to about $175 billion. The next day, the stock rose 15.5%, its biggest one-day gain since 2008. Adding roughly $480 billion of market value. The market rewarded the same spending it had punished 3 months earlier, because this time the revenue showed up alongside it. Here is the honest framing of the debate. The stock closed at $464.72 on the 31st of July, about $3.45 trillion of market value, at roughly 25.9 times trailing earnings. Consensus price targets average about $559, with a $400 low. One widely followed fair value estimate sits near $480. Nobody disagrees about the revenue. They disagree about what the capex is worth. What just happened? The 31st of July, Microsoft closed at $464.22, a $3.45 trillion market value, keeping its strongest week since 2008, and erasing most of the year's decline. Before these results, the stock had been down about 19% year to date. The next catalyst is fiscal 2027 first quarter print, with Azure guided to roughly 45% growth and capital spending about 50 billion in that quarter. The 13th share rose 15.5% in a single session, later adding roughly $480 billion of market value, and analysts lifted price target across the board. The 29th fiscal fourth quarter and full year results. Revenue $90 billion, up 18%. Earnings per share $4.81. Azure up 43%, and passed 100 billion for a year. And calendar 2026 capex restated to about 175 billion. The 25th of June, Europe regulator reached a preliminary review that Azure and AWS should be decided gatekeepers on the Digital Market Act after a 7 months investigation. They will bring obligation on self-preferencing interoperability and data portability. And on the 2nd of June, the FTC escalated its own probe, issuing civil investigative demands to at least 6 Microsoft competitors in cloud and business software. The theory is bundling Windows Office, security, and AI so in a way that makes living expensive. Let's look at the capital and margin. 1. The capex is the story. Roughly $175 billion of calendar 2026 capital spending, and the fiscal 2027 guiding higher again, about $50 billion in the September quarter alone. Every valuation argument still runs through return on that number, not through Azure growth. 2. Depreciation is coming. 2/3 of spending is short-life GPU and CPU hardware. Gross margin has slipped to 67%. Another new wrinkle. Microsoft has just extended the estimated useful life of its data centers and office buildings from 15 years to 25, which softer near-term depreciation but does not change the physical life of a GPU. Worth watching closely. 3. Cash flow compression. Free cash flow was $19.6 billion in the June quarter against $41 billion of capital spending. The Bureau now costs more in a quarter than the free cash flow the business produces in one. 4. Component inflation. Higher memory and semiconductor prices sit inside at record $41 billion, a cost Microsoft does not control and cannot engineer away. None of these kill the company, and the market has just decided it can live with them. But they are why a business earning roughly $40 billion of operating income. A quarter spent most of this year trading at a discount. Then let's look at regulation dependency adoption. Regulation on two fronts, and this is new. The FTC is examining licensing interoperability and boundary across Windows Office, security, and AI. Separately, on the 25th of June, the Commission reached a preliminary review that Azure should be designated a gatekeeper under the Digital Market Act, with fines of up to 10% of worldwide turnover for non-compliance. Neither is a near-term revenue event. Both concern how Microsoft is allowed to bundle, which is the core commercial mechanic of the whole company. The OpenAI respect exclusivity is gone. OpenAI can sell across AWS and Google Cloud, and a large share of that backlog. Now $678 billion, up 84%, sits with one counterparty. Concentration risk in the backlog is still concentration risk. Copilot conversation. 30 million pay sets sounds enormous when it is, but it is only about 6.5% of the commercial base. And in paid consumer AI subscriptions, Microsoft has been losing share to ChatGPT. Distribution is an advantage. It is not a sensing the preference. And capacity, not demand. Management has described the capacity as tight for 6 straight quarters. Power, land, and components now set a ceiling on Azure growth, not customer appetite. This is an unusual constraint, and it is not one you face with a better sales motion. For a decade, the bear case on Microsoft was growth. It is now capital intensity, regulation, and counterparty risk. After a 15% one-day rate, multiple leaves runs room for loss than it did a week ago. In the end, there are 3 things to take away. 1. The software franchise is the company. Productivity and the intelligent cloud carry effectively all of the growth and all of the margin. If you own Microsoft, you mostly own enterprise software with a very large cloud attached. 2. The Buildout is the option. Everything above today's earnings, agents, AI platform, sure. The next decade of Azure is priced of $175 billion a year construction program. Bonds returns are only starting to show in the revenue line. 3. The price assumes both work. At about 3.45 trillion and 25.9 times earnings. This is no longer the discounted stock it was a week ago, but the consensus target near $559 and the server fair value estimate near $480 now sits about $80 apart. That gap is entirely about the CapEx. That's not a sales signal. It's just a sum of what you are buying. Next week, episode 6, Amazon. The Azure cloud and the Azure Buildout, and where AWS can hold the ground it has left. If this was useful, subscribe. I will see you next week.